Okay, and we should be recording now. So we are going to be talking today about Deck 10. So hopefully you've got that out. And today's lecture focuses entirely on Section 85, which is a provision that allows for tax-deferred transfers from shareholders to corporations. And so we're going to drill into how this works. Reasonably important topic. Those of you who are just going to practice corporate law, in Edmonton, Saskatoon, somewhere like that, you will see Section 85 a lot because you will be required to draft documents to implement Section 85 rollovers because accountants, or partners in your firm or whoever will ask you to do this. So again, this is a reasonably important provision, even if you aren't going to be a tax lawyer, but assuming that you are going to end up in some kind of corporate commercial practice. So flipping to slide 2, we can talk a little bit about why we have Section 85 and kind of what our purpose here is. And this goes back to week 2 and our discussion in week 2 about how a transfer of property to a corporation is a disposition within the meaning in subsection 248(1), because the corporation is a separate taxpayer for tax purposes and a separate person. As a result, the transfer of property to a corporation by a shareholder could result in the realization of a gain, a loss, a capital gain, or a capital loss. It could result in as well in recaptured CCA, depending on the type of property that's being transferred. However, that being said, there are a couple of reasons why we don't want this rule to apply in all circumstances, why we wouldn't want there to be a disposition that could result in tax. First, and going back to our neutrality principle that we talked about in week 2, we don't want tax to dictate what people are doing in terms of corporate commercial structure. There are good reasons why startup businesses, for example, would not be incorporated, simply in many cases due to their informality and their small size. And we don't want to force the incorporation of startups from day one of their operations in order to avoid tax at some later point when incorporation would become necessary. So, it makes sense that we let people incorporate businesses after the business has already become a going concern, and we only impose so much tax on that incorporation as is justified by neutrality concerns. And very often that amount of tax is zero, because what will usually happen is that the people who have founded this new business are just going to have the same economic investment in the corporation that will now carry on the business. So since everyone's still economically invested in the same property and the same business, it doesn't make a lot of sense to impose any tax at all. In most instances, there are sometimes that does break down, even where you have people who are, entirely economically invested in the same property to the exact same extent that they were before. But by and large, that principle holds. Secondly, and not entirely separate from the first point about neutrality, is that we want to be able to incorporate businesses or transfer assets to corporations after the fact, because we don't want to penalize ignorance. Like I said, startup businesses are often pretty informal, and it might be a while before good tax advice, or really any tax advice, is obtained by the people carrying on the business. It may be that due to its limited size and informal nature, they just can't afford to get tax advice at an earlier stage in the proceedings. And so if we didn't allow tax neutral incorporations of businesses later on, people who did not initially incorporate would have to either never incorporate and thus would never be able to claim the small business deduction, would never be able to claim a capital gains deduction on the disposition of their shares, or they would have to pay a tax cost to incorporate, which they may not have the cash to do that, even if the business has value and the business assets have value. And even if they did, that cash would probably, in an economic sense, be better used for both from the perspective of the business owner and from the perspective of the society, would be better used to grow the business, right? So, we don't want to do that. We don't want to create this penalty or this prophylactic on incorporation, especially when, in the real world, to be a business of any size, you realistically need to be a corporation. So that's, we don't want to do that. As well, again, if we did prevent people from accessing the capital gains deduction or accessing the small business deduction because they didn't have the tax foresight to get advice before commencing carrying on a business in a non-incorporated form, then first of all, we would really undercut the policy rationale for the small business deduction and the capital gains deduction, which are supposed to reward entrepreneurship and allow people to save money to reinvest in the business, etc. And we would make these things really regressive, right? Because people who don't have the money or the expertise upon the commencement of the business would have either this, would just be effectively prohibited from accessing these things, or they would have a penalty in order to access them. So this is a problem, and this is a problem that's very easily corrected if we just simply let people incorporate businesses after they've already started being carried on. So if we flip to slide 3, we can now see that this is where the concept of a tax deferred, aka a rollover transaction, comes into play. As a really pedantic point, I dislike the word rollover in formal writing or as a title for an agreement, but we're going to use it here because it's really useful shorthand. It's vernacular. Everybody knows what we mean when we talk about a rollover transaction. You saw examples of rollover transactions in your baby tax course, for example, like spousal rollovers. So this should be familiar territory, at least conceptually, for you. The basic principle with a rollover transaction is that a person who disposes of a property in exchange for certain other types of property is deemed to have disposed of the transferred property for proceeds of disposition generally equal to the cost amount of the property that they disposed of, and not for the fair market value of the consideration received on the disposition, as would normally be the case. In order to not confer a benefit and to make this a rollover and not just a straight exemption, what will happen is that the transferor is going to be deemed to have cost in their consideration received for the transferred property equal to the cost of the transferred property. So as a result, whatever accrued gain, or in some instances, but not with Section 85, as we'll see in a bit, whatever accrued gain there was on the property at the time of the transfer, that gets preserved in the new property. And so whenever they dispose of the new property, if that is not itself a rollover transaction, then they'll realize the tax on the gain at that point. So that's the idea. It's simply a deferral. Again, the acquirer of the property, again, with a couple exceptions, which we'll talk about later this week and in a different rollover provision next week, generally acquires the property that they received from the transferor at its cost amount to the transferor. So they also have an accrued gain on this property. And so if the transferee disposes of the acquired property that they've acquired from the transferor, then they would have a capital gain or capital loss, or they'd have an inventory gain or inventory loss as well on that disposition. So basically it's just a straight carryover of tax attributes from the old property into the new property and from the old owner to the new owner. Conceptually, hopefully that makes conceptual sense. And basically every rollover provision in income tax world builds on that premise. Again, sometimes not with the losses, as we're going to see, but generally speaking, the tax attributes of the property get preserved. And so this is how Section 85 works at a very high level, right? You can transfer property to a corporation, provided that some conditions are met. And the shares of the corporation that you receive in exchange will have ACB equal to the cost amount of the transferred property. The transferor, again, in most instances, realizes no gain or loss on the property unless they elect to realize a gain or loss, which we'll talk about in a little bit. The corporation acquires the property from the shareholder with the historic cost in the property. And so any disposition by the corporation of the transferred property is going to result in gain or loss and tax becoming payable. And similarly, any disposition of the shares of the corporation received by the shareholder is going to result in gain or loss being realized and tax becoming payable. So is everybody okay with the concepts? Okay, seeing nobody, let's flip to slide 4. And we can move to talking about the actual conditions for the application of Section 85. So in order for subsection 85.1, which is the main rollover provision, to apply, the first condition is that the taxpayer must have disposed of eligible property, which we'll talk about what eligible property is in just a moment. Next, the transferee has to be a taxable Canadian corporation. And again, you'll recall that a taxable Canadian corporation is defined in subsection 89.1. And for our purposes, it generally means a corporation that was incorporated in Canada and that is not exempt from Part 1 income tax for some reason. So transferee must be a taxable Canadian corporation. Next, the consideration has to include at least one share of the transferee corporation. So again, important thing to keep in mind there is that it has to be, the consideration has to include at least one share. It does not have to be exclusively share consideration. Next week, which I guess isn't next week, it's next class, it's 2 weeks because of Good Friday. But next class, we're going to look at some rollovers where the consideration effectively has to be exclusively share consideration. That's not Section 85. You just need some share consideration in order to have at least a partially tax-deferred transaction. Finally, subsection 85.1 requires that the parties file an election in prescribed form, which is CRA form T2057, on or before the earliest day that the transferee or transferor is required to file its tax return for the taxation year in which the transfer occurred. So generally speaking, if you have an individual transferring property to a corporation in, let's say, 2021, which the earliest of those days is going to queue itself off of effectively the year ends for the individual, which is always a calendar year, and the year end for the corporation. So again, if it's an individual transferring property to a corporation, the T2057 is never going to be due later than April 30th of the next year. So if it was 2021, it would never be due later than April 30, 2022. And it could be due earlier if the corporation had a taxation year ending before October 31 of the year in which the property was transferred. You could have an earlier due date for the T2057. So as a practice point, always make sure that you're having some kind of a system to record when T2057s are due, if filing them is your responsibility. And if it's not your responsibility, make sure that you're very clearly stating whose responsibility that is. It's not a big deal if you have to file late with the T2057. It's like a $100 penalty. And sometimes, like all penalties, it's sometimes smarter to just pay the penalty. One of the things you will discover in practice is that accountants abhor paying those penalties and will sometimes do incredibly stupid things in order to avoid the client having to pay a $100 penalty, like filing a T27 when they don't really know what the tax attributes were, or completely understand the underlying transaction, and then get it wrong, and then you're having to go to the CRA and tell them that your T2057 is wrong, which invites all kinds of further questions that you don't want to answer. So, like I said, sometimes it's a good idea to pay the $100 penalty, per month, obviously, so it can start ratcheting up. But do make sure that you're at least deliberately exposing yourself to that penalty, and so make sure that if your practice includes filing the T2057s, that you're diarizing the obligation to file. So that little professional responsibility and practice segue aside, we can now turn to a discussion of what eligible property is. And eligible property is defined in subsection 85(1.1). And what you'll see if you flipped over to that subsection is that there's a lot of different types of eligible property. So generally speaking, where the transferor is a person resident in Canada, eligible property includes capital property, resource property, business inventory other than real property, and financial instruments. The major problem with subsection 85(1.1) and this concept of eligible property that you will encounter in practice with some frequency is that land inventory is not included in the definition of eligible property. So this means that real estate can only be transferred to a corporation under subsection 85(1) if the property is capital property. And so this means that unless you want to employ a more sophisticated method for circumventing this restriction, you have to be very sure when you transfer real property to a corporation that the real property is capital property and is not inventory. Because if it is inventory, then that's just a taxable transaction, and you're going to realize business income upon the transfer. And given that individuals are taxed on business income at, let's call it 48%, rather than either 11% or 23% like a corporation would be, that's a really significant gap. So that's eligible property. Like I said, there are ways to circumvent that, most notably what you'd call a Loyens transaction that uses a partnership as an intermediary to accomplish your land transfer. And again, you'll see that in practice. But yeah, the warning about land inventory aside, pretty much anything that you would think of wanting to transfer to a corporation will be eligible property. Yes, we have a question from David. Or from Thomas, rather.
Hi. Sorry. Can you hear me?
Yep, I can hear you.
Okay, so I was reading the definition in 1.1a. So it says the capital property, and in brackets it says other than real or immovable property, and there is a long list of things. And it's ended by owned by a non-resident person. So that means that does it apply only for the non-resident person, or it covers everything?
Yeah, so the idea is that if you're looking at paragraph 85(1.1a, which is what, so if everyone wants to flip to paragraph 85(1.1a, which is what Thomas is asking about, you'll see that it defines an eligible property in paragraph 85(1.1a as a capital property, and then you have in parentheses other than real or movable property, or an option in respect of such property, or an interest in real property, or a real right in an immovable. Don't worry if you don't know what a real right in an immovable is. That's Quebec talk for real property. So it's basically an option in real property owned by a non-resident person. So to answer Thomas's question, if your capital property is real property and your transferor is a resident of Canada, then that's fine. However, what this is saying is that generally speaking, a non-resident person cannot transfer real property that is capital property to a corporation under subsection 85(1). So that is that's the answer. Although if you then, even then, there's a further caveat, which if you drop down to paragraph 85(1.1)(h), you'll see that in this case, a non-resident person can, in some instances, transfer real property that is capital property to a corporation under subsection 85(1), but that has to be real capital property used in the business, carried on in Canada by the non-resident person. And so the reason why we have this exception for why non-residents don't get to transfer real property that is capital property to a corporation the way that a resident person would is that we are concerned about the non-resident person ducking out on Canadian tax as a result of the transfer. So the way, again, and those of you who are taking international tax right now, this is review. For those of you who are not, the way Canada's tax rules work and the way generally our treaties with other countries work is that non-residents of Canada have to pay tax on their capital gains that are sourced to Canada on real property. We have a means of collecting this tax under Section 116, and we do not cede this right to other countries under our tax treaties. So the concern here is that if these individuals could transfer, like non-resident individuals, could be non-resident corporations too, but let's just use non-resident individuals because it's easier. If they could transfer the real property to a corporation on a tax-deferred basis under Section 85, it's possible that they could transfer the real property to a corporation that would have other assets and potentially significant other assets that are not real property. And the result would be that the shares of the corporation they've received back on the transfer would not be what we call taxable Canadian property, which basically just means property that derives more than 50% of its value from real estate, and in respect of which we will tax non-residents on a disposition. And so they could basically wash their taxable Canadian property. They could transfer the real property to this corporation, the shares of which would not be taxable Canadian property. And then they could sell the shares of the corporation and there would be no Canadian tax on the sale of the shares. Or potentially, depending on, even if at some point in time the value of the shares is more than 50% derived from Canadian real property, it may be that under the treaty, the shares are still exempt, if they live in a treaty jurisdiction, and again, would just be able to skate on the Canadian tax. So we're making it here at least a little bit difficult for non-residents to skate on Canadian tax by transferring Canadian real property to a corporation under Section 85 on a tax-deferred basis. But again, we're allowing them to use to transfer business property to a corporation under Section 85, on the assumption that there's a significant enough connection to Canada and to investment in productive investment in Canada that will allow us. So that is Thomas's question. Did anybody have any other questions about eligible property? Okay, seeing none, the last point we wanted to talk about on this slide is just a transfer under Section 85 where there's multiple properties. So if you have, let's say you wanted to, let's use our example where we're incorporating a business as being carried on. Let's suppose that we have, I realize that this is the 21st century and nobody carries on bricks and mortar business anymore, but let's suppose that we have an industrial business. And so we have, for example, inventory, like raw materials inventory, work in progress inventory, completed goods inventory, machinery. We have land and buildings, the land being, the subjacent land to, let's say, our factory, and our buildings being the actual factory buildings themselves. We have goodwill associated with the operation. Suppose we also have some patents, copyrights, trademarks, etc., that are connected with the business. And we want to transfer all of that stuff to a corporation under Section 85. So you have multiple properties. We're trying to have, when you break out all of these things, you probably have dozens of properties, right? Since every class, not just any class, any individual depreciable property is going to be a separate property for these purposes. And so what happens here is that Section 85 applies to that kind of a transfer on a property by property basis. And so it's necessary for the consideration that's being received on the Section 85 transfer to be allocated between all of the transferred properties, and for the deeming rules in Section 85, which we're going to talk about in a moment, to be applied to each particular property that's being transferred. In the event that there are multiple properties that are disposed of, and those multiple properties are depreciable property, then paragraph 85(1)(e)(1) requires that the taxpayer designate an order in which the depreciable properties are disposed of, even if they were all disposed of at exactly the same time for commercial purposes. And for commercial purposes, they almost always are disposed of at exactly the same time. And the reason you would do that is just to manage your CCA pools, right? It's just to determine how much recapture income that you realize on the transfer, if any. It does matter which order the properties come out of your CCA pools. So that's why 85(1)(e)(1) is there. But generally, the takeaway here is that if you have Section 85(1) applying to multiple properties, it applies on a property by property basis. And so with that, we could flip to slide 5. Before we do that, I do think it's actually useful to just do a little bit of a walkthrough of the structure of Section 85 and the deeming rules before we do that. So if we want to pull out our acts, which hopefully everyone's got in front of them right now, and just flip to subsection 85(1). And what you'll see first is that in the preamble, which is basically what we just talked about with slide 4, is the preamble of subsection 85(1). And then you see a bunch of different paragraphs, and these are all deeming rules. So the first is that is paragraph 85(1)(a), and paragraph 85(1)(a) is the provision that actually affects the rollover. And so what paragraph 85(1)(a) says is that the transferor's proceeds of disposition and the transferee's cost in the acquired property are deemed to be the elected amount. So whatever amount we elect under Section 85 as the proceeds of disposition for the transaction, that's the elected amount, right? That's the proceeds of disposition. That's the cost in the acquired property. So far, so good. Then we drop to paragraph B, and paragraph B is the first of our deeming rules that dictates what the elected amount can or cannot be. So the first is, again, is paragraph B. And what it provides is that you cannot have an elected amount that is less than your non-share consideration. So this gets referred to as boot. I'm not exactly sure how that term came about. If they, like the early drafters of the Income Tax Act were talking like pirates and calling it booty or something. But anyway, it's boot. You cannot have an elected amount as consideration that's less than the fair market value of the non-share consideration received on the transfer. Non-share consideration can include things like shareholder loan, assumption of debt, cash, shares of another corporation, etc. Anything that is not shares of the transferee corporation. So that's effectively a lower amount of the range. Next, we can drop to paragraph C, and paragraph C is again a deeming rule. And this paragraph C is intended to set a high end of the range. So under paragraph C, you cannot elect at an elected amount that's higher than the fair market value of the transferred property. So if this usually comes into play when you're trying to transfer property with an accrued loss to a corporation. And because of paragraph C, you can't elect under subsection 85(1) to transfer the property at cost. If there's an accrued loss, you have to transfer it at, and you have to elect an amount that is not higher than fair market value. So think of this as effectively a lower of cost or market rule on an election. What we will see, and if we may have seen in baby tax talking about superficial losses, is that there may be circumstances where in fact you effectively get treated as though you had been able to elect at at cost, but for all intents and purposes, paragraph C is a hard upper limit at the fair market value of the transferred property. Then we can drop to C.1, and paragraph C.1 is a lower bounds. And so generally speaking, you cannot elect under subsection 85 at an amount that is less than the lesser of the fair market value of the property or the cost to the taxpayer of the property disposed of. So again, this is just reinforcing our lower of cost or market rule. Then we can skip C.2 because C.2 deals with farm property and I don't care. Finally, then we just have paragraph E, and paragraph E deals with depreciable property, and it forces you to elect at a minimum amount that is not less than the lesser of the UCC of all property of the class, the cost of the particular depreciable property, and the fair market value of the depreciable property at the time of the transfer. So that's all well and good. We'll talk about many of these other things later. And then if we go back, and then the last thing we want to look at is paragraphs F, G, and H. And what paragraphs F, G, and H are, these are our cost of consideration provisions. So obviously, if you have disposed of property to a corporation, you've elected and you result under paragraphs B, C, and C.1 is that you were entitled to elect at an amount that's less than the fair market value of the property. So you've deferred a gain. We're not going to let you have full cost in the property you've taken back. So we need rules to allocate the elected amount between the different types of property or the different properties of the same type that have been received as consideration for the transfer to the corporation. And this is what paragraphs F, G, and H do. So, and they apply in the order that they appear. So paragraph F basically says, if you have non-share consideration received for the property transferred to the corporation, then you have to allocate the elected amount and therefore the cost of the consideration received first to the non-share consideration up to a maximum of the fair market value of the non-share consideration. And so since we know that paragraph B says we can never elect at less than the fair market value of the non-share consideration, the combination of paragraphs B and F means that we will never have a delta between the cost of the fair market, the cost of the non-share consideration received on the Section 85 transfer and the fair market value of the non-share consideration. The minimum elected amount will always be the fair market value of the non-share consideration. Then if we have a leftover elected amount, either because we elected an amount that was higher than the fair market value of the non-share consideration, or because we just had no non-share consideration whatsoever, then we drop down to paragraph G. And paragraph G says basically everything, all elected amount that you did not allocate to the non-share consideration gets allocated to the cost of any preferred shares received as consideration up to a maximum of the fair market value of the preferred shares that were received as consideration. So this is the first of these three rules where you might have a shortfall, where there might be less elected amount than there is fair market value of preferred shares. And that's fine. That can happen. That in fact happens all the time, right? And that just means that there's going to be a locked-in accrued gain on those preferred shares. And when they're disposed of, the shareholder is going to have to report that capital gain and pay tax on it. So that's all well and good. And then paragraph H basically says that if you've gone through paragraphs F and G and you still have some elected amount remaining, then that elected amount gets allocated to the cost of the common shares of the corporation received as consideration. So that's the catch-all bucket. You'll never have elected amount remaining after you've applied paragraph H. If you've gone through F and G, and there's an elected amount remaining, let's say because there's no non-share consideration, no preferred share consideration, which again happens all the time, then it's just whatever the elected amount was becomes the cost amount of the common shares received on the exchange. So that's subsection 85.1 in a nutshell. And so barring any questions, we can go to some problems, and the problems will hopefully shed some more light on how these rules work. Jacob.
Hey, do you mind just repeating how you could have some excess left over after doing paragraph G? Like, how would you have more than could be in the preferred shares?
Yeah, so let's suppose, for example, let's use an easy example. Suppose I transferred property with a cost of let's call it a fair market value of $10 million and a cost of $1 million to a corporation. I elected under subsection 85.1 for proceeds of $1 million, so it becomes a tax deferred transaction. Suppose I received no non-share consideration and I received back $900,000 of preferred shares and 100 common shares. And so the 100 common shares obviously just have value equal to $9.1 million because that's how common shares work. So in this case, the preferred shares, they only represent $900,000 of the total $100,000 elected amount. So I would have to allocate my ACB under paragraph G, $900,000 of the elected amount to the preferred shares. So now the preferred shares have cost, they have ACB and fair market value of $900,000. And then I would allocate the remaining $100,000 of elected amount to my common shares under paragraph H. So they now have fair market value of $9.1 million and cost of $100,000. So there's a well, it's not a locked in because the common share values will fluctuate, but there is at the exact moment in time an accrued gain of $9 million on the common shares.
Perfect. Thanks so much.
Welcome. Leah.
I just want to confirm that F, G, and H apply where we elect an amount at an amount lower than fair value, and then we just allocate according to F, G, and H. Is that correct?
That's correct. Yeah, I mean, theoretically, F, G, and H also apply where you elect at fair market value, which is, again, sometimes people do that. They'll file Section 85 elections on a protective basis, where they want the transfer to happen at fair market value, or they'll file it because they don't want another deferral provision to apply. We're going to see next week how there's some deferral provisions that are subordinate to Section 85, and so by filing an election to transact at fair market value, then you can be in Section 85. But it's a little bit of a ramble. The point was that paragraphs F, G, and H theoretically apply where you elect at fair market value. However, they're kind of irrelevant where you elect at fair market value, because at that point, you know that every property you receive as consideration is going to have cost equal to fair market value. So who cares, right? But yes, generally speaking, where you really care about F, G, and H is where the elected amount is less than the fair market value of the transferred property. And so you know that there's going to be less cost of consideration than there is fair market value of consideration. And so then you need rules to allocate that cost of consideration between the different types of property. And that's what F, G, and H do.
Okay, thank you.
Welcome. Anybody else before I move on? Okay, seeing nobody, we can go. We're now on slide 5, and we can look at some problems. So in problem 3A, we have a transferor. Let's just, I think it's an individual that we're assuming here. Individual transfers land held as capital property to ACO. On the transfer, ACO assumes $125,000 of outstanding liabilities of individual A and issues 1 common share to individual A. The land has an ACB of $100,000 and a fair market value of $150,000 at the time of the transfer. So that is the base problem in 3A. And so as we work through 3A and various other problems in question 3, I'm going to assume that every corporation mentioned in this problem is a taxable Canadian corporation, unless otherwise specified. And I'm going to assume that a timely election has been filed under Section 85, in which the taxpayers elect to transfer at an elected amount that maximizes the tax deferral. So whatever the largest deferral we can get is the amount that we're going to elect at. And again, the last part of that assumption is critical because sometimes people do elect to transact either at a partial gain or at fair market value and realize the whole gain. And they might want to do that, for example, because they have unused capital losses and would like to soak up those capital losses in this, upon this transfer. The other place we might see it is, for example, if you have the misfortune of doing farm tax stuff, you may see this where people want to transfer, let's say, farmland to a corporation and claim their capital gains deduction on the transfer of the farmland. They may elect at a higher value in order to take back a tax-paid shareholder loan on that transfer. So again, the fact that the assumption that we're electing to maximize deferral is an important assumption. The final assumption that we're going to make is that any land that is transferred to a corporation is capital property if the problem doesn't expressly state that it's either capital property or inventory. So if we're assuming that land is capital property, then we know that it's an eligible property, again, on the assumption that all of our people are residents in this course, that again, we're not going to have non-residents unless it's very explicitly stated that we're dealing with a non-resident. And so as a result of that assumption, we know that any property that's being transferred to the corporation is an eligible property as defined in subsection 85.1.1. So then, now that we've assumed away all of the conditions of application of Section 85, we can look at what's going to happen here, right? So because we've satisfied all the conditions of application, we know we've affirmatively elected. So subsection 85.1 applies. So we can then go to paragraphs B, C, and C.1. So we know that in this case, because of the application of paragraph B, the elected amount cannot be less than the fair market value of the debt relief of $125,000. We know that we know that the elected amount cannot be more than the fair market value of the land, which is $150,000. And we know that the elected amount cannot be less than the tax cost of the land, which is $100,000. So what you're probably saying to yourself as you're working through this is, well, that sounds like a conflict between paragraph B and paragraph C.1. That paragraph B is saying the lower bound for the elected amount is $125,000, and paragraph C.1 is saying, nuh-uh, the lower bound for the elected amount is $100,000, which is the cost of the property. And so this conflict is anticipated by the drafters of the legislation, and it's resolved by paragraph 85.1 E.3. And it requires the elected amount, lower bound, to be the greater of the amount determined under paragraph 85.1b and the amount determined under paragraph 85.1c.1. And so in this case, since our amount determined under paragraph 85.1b is greater than the amount under paragraph 85.1c.1, paragraph 85.1e.3 provides that paragraph 85.1b governs. And so the lower bound for our elected amount has to be the $125,000 determined under paragraph 85.1b. And so this gives us a range now that we have between $125,000 as the lower bound and $150,000 as the upper bound. And so individual A and corporation A Co could elect anywhere within that range under section 85. Given that we've assumed that they're going to elect for maximum deferral, then that means that they're going to elect at $125,000, which is the lower bound in the range. So after they've made that election, then paragraph 85.1a kicks in, and it deems individual A to have disposed of the land for $125,000, and it deems ACO to have paid $125,000 for the land. Paragraph 85.1f then applies to our individual A to deal with their cost of consideration, and it's going to deem the entire amount of the cost of consideration to be allocable to the non-share consideration, which was the $125,000 of debt relief. And so as a result, when we get to paragraph 85.1h, which is our common share cost of consideration provision, we have no elected amount remaining. And so as a result, our one common share of ACO has ACB of nil going forward. And so there's a $25,000 accrued capital gain on the share of ACO. And so if individual A ever disposes of that share of ACO, then individual A is going to realize a $25,000 capital gain. ACO, again, is deemed to have cost in the land of $125,000. And so there's an accrued gain on the land of $25,000. And if ACO disposes of the land, then ACO is going to have to realize that $25,000 capital gain and pay tax on that capital gain. A has also realized a capital gain of $25,000 on this transfer because the minimum elected amount is $25,000 greater than the cost of the land at the time of the transfer. And so that means there's going to be a taxable capital gain of $12,500, and A is going to have to pay tax at, let's call it 48% on that $12,500 capital gain. So that's the base case problem. Is everybody okay with that so far? Okay, seeing nobody, we can then go on to our second iteration of the same problem, which is the exact same facts, but instead of an assumption of liabilities for $125,000, ACO issues a promissory note to individual A, and the promissory note has a fair market value of $175,000, presumably because it's backed with ACO's other assets and not just the land, so it actually has positive fair market value. So in this iteration, what we're trying to tease out is the application of paragraph 85.1c. And so what will happen here is that if we, obviously paragraph 8, again, our provisions of our conditions of application are all satisfied. If we drop to paragraphs B, C, and C.1, right, paragraph 85.1b is going to deem the minimum elected amount to be not less than $175,000, while at the same time, paragraph 85.1c is going to apply to deem the maximum elected amount to be the fair market value of the land, which is $150,000. Paragraph 85(1)(c)(1) continues to apply to deem the minimum elected amount to be $100,000. And so again, we already know that under paragraph 85(1)(e)(3), this conflict between paragraph B and C.1 gets resolved in favor of paragraph B because it's the higher of the two amounts on these facts. But we still have this conflict now between paragraph B, which is saying that our minimum elected amount is greater than what paragraph 85(1)(c) says is our maximum elected amount. And if you've already looked at paragraph 85(1)(e)(3), you'll see that there is nothing in there that resolves the dispute. And so this becomes a basically just a statutory interpretation exercise, right? That if you look at the wording of paragraph 85(1)(b), it says subject to paragraph 85(1)(c). And well, that actually says subject to paragraph C, but anyway, it means paragraph 85(1)(c). And so what that tells you is that whenever there is a conflict between paragraph 85(1)(b) and paragraph 85(1)(c), paragraph 85(1)(c) governs. And so as a result, we're pretty locked into what the elected amount has to be here. It can't be less than $150,000 because that's the point at which the conflict between paragraphs B and C kicks in, and it can't be more than $150,000 because paragraph 85(1)(c) governs and prohibits that. And so the result is that the elected amount is exactly $150,000. And so again, applying then paragraph 85(1)(a) kicks in. The elected amount is $150,000. A's proceeds of disposition are $150,000. ACO's cost on the land is $150,000. We then drop to paragraphs F, G, and H. And under paragraphs F, G, and H, we have to allocate this $150,000 of cost to consideration. And the only consideration we have is now non-share consideration. And well, we have one common share as well. But our non-share consideration is a fair market value of $175,000, which is in fact more than our elected amount. So this is actually a situation where what I said earlier about paragraphs B and F never conflicting, this is the situation where it doesn't hold because paragraph C has overruled paragraph B. And so we're going to have $150,000 of cost consideration. All of that gets allocated under paragraph F to the promissory note. So the promissory note now has a fair market value of $175,000 and an ACB of $150,000. Because there's no elected amount left, then when we drop to paragraph H, the cost of our one common share received as consideration is $0. And so that share has a fair market value of presumably nil and an ACB of nil as well. So that's where we're at. Individual A has obviously realized a capital gain of $150,000. Sorry, capital gain of $50,000 rather, which is the $150,000 of elected amount less the ACB of the land of $100,000. So $50,000 capital gain, $25,000 taxable capital gain, and they pay tax at 48% on that $25,000 capital gain. And then ACO has cost on the land of $150,000. The land has a fair market value of $150,000. So ACO can dispose of the land with no further tax consequences. So now you may be asking yourself, well, okay, so now I have this weird situation where I've got non-share consideration with a fair market value that exceeds its cost, which isn't supposed to happen under subsection 85(1). So what happens now? And the answer to what happens now is probably that this $25,000 difference, which represents an amount that the corporation paid to a shareholder in excess of the fair market value of the transferred property, is probably a shareholder benefit that gets included in the individual shareholder's income under subsection 15.1. And so we probably, as a result of that income inclusion, have an upward adjustment in the ACV of the promissory note under subsection 52.1. And so our individual A does end up with a cost of $175,000 in the note, but it's not because of section 85.1 necessarily. It's because they've had to pay tax on a shareholder benefit of $25,000 in order to close that gap. So in practice, you would never allow this to happen, right? Shareholder benefits are really bad because they're full income inclusions with no offsetting deduction for the corporation. So you would never allow this to happen. And the way you would avoid this problem in practice would be to use a price adjustment clause. And what the price adjustment clause would do is it would provide the amount, the principal amount of the promissory note gets reduced on a dollar for dollar basis for every dollar above the fair market value of the land that the original amount of the note was. So in this case, if you had a price adjustment clause, it would reduce the principal amount of the note to $150,000, and everyone would, go on with their lives. There'd be no shareholder benefit, and we wouldn't have this problem necessarily that's being teased out in the question. However, price adjustment clauses are ineffective if you make no attempt to actually value the asset, or if you just deliberately choose to transact at a price that you know is not representative of the cost of the transferred asset. There's a line of cases starting with a federal court trial division case called Gilder News that carries on with that principle. So you do need to be very careful with price adjustment clauses to make sure that you're at least making some kind of bona fide attempt to value the transferred property before you do the transfer in order to not have an ineffective price adjustment clause. So that's problem 3A. Does anybody have any questions? Okay, seeing nobody, I'm going to stop recording.